Hello, everyone. Thanks for joining me today. When war breaks out, everyone panics. Everyone tries to sell, run, hide. And right in that moment, a small group of people sits down, does the math, and starts building the biggest wealth of their lives. These people weren't lucky. They weren't crazy. They just saw something that everyone else couldn't. And today, I'm going to tell you exactly what they saw. Think about this. Iran-US tensions are escalating. News channels are on fire. Social media is losing its mind. And right now, you're staring at a screen, wondering what's going to happen to your money. Does that feeling sound familiar? Because that exact feeling is what millions of people have felt throughout history. And the majority of those millions either panicked and sold everything, or froze up and did absolutely nothing. Both were wrong. But there was always a small minority. During the Gulf War, during Afghanistan, during the Ukraine crisis, during dozens of geopolitical shocks before that. These people did the exact opposite of the crowd, and this video is going to break down exactly what they did, why they did it, and how you can do the same thing today. Stay with me, because this might be the most important thing you ever learn about money. Real quick, I want to ask you something. When you see a crisis headline, what's your first instinct? Sell your positions, move everything to cash, or just do nothing and wait for it to blow over? Drop it in the comments. I'm genuinely curious, because your answer tells me exactly where you stand right now. Okay, let's go back to 1990. Iraq invades Kuwait. The Gulf War is about to begin. Oil prices nearly doubled overnight. Markets started shaking. The S&P 500 dropped roughly 16% between July and October of 1990. Panic was everywhere. The majority of people sold right at that point. But one group of people did the exact opposite. That group looked at their holdings and thought, the underlying value didn't change. These things just got cheaper, and they bought at those lower prices. What happened when the conflict ended? The S&P 500 rallied roughly 29% from that low by the end of 1991. The sellers locked in losses. The ones who stayed calm made serious money. But that's just the beginning, because the really interesting part comes after this. Let me zoom out further. Afghanistan War, 2001. The longest war in American history, 20 years. So what did the people who invested in the defense sector during those 20 years actually see? Here's the thing. Stop for a second and think about this number. If in September 2001, you had put $10,000 across America's 5 biggest defense contractors, Lockheed Martin, Raytheon, General Dynamics, Northrop Grumman, Boeing, just $10,000 split across those 5 companies. By 2021, when the war officially ended, that $10,000 would have become $97,000. $97,000. If you had put that same $10,000 into the S&P 500 over the same period, $62,000, 58% less. Think about that for a second. That is a pattern, and the people who knew this pattern were looking in the right direction while everyone else was running scared. All right, now let's get into the actual substance. People who built wealth during wars and geopolitical crises throughout history all did 3 things, just 3 things. And once you understand them, you will never look at a crisis headline the same way again. The first thing, they saw the opportunity that the panicking crowd was creating. Here's the best way to understand this. Imagine your favorite store runs a massive sale. Everything is 30 or 40% off. What do? You fill up your cart, right? But when the exact same thing happens in the market, when prices fall, people do the complete opposite. They run. Why? Because fear kicks in, and fear shuts down logic. And this is exactly the moment wealth changes hands. Here's a data point that should be tattooed in your brain. Hartford Funds analyzed 30 major geopolitical crises over the last 50 years. The result was the same every single time. The S&P 500 recovered from every war-related sell-off within an average of just 47 trading days. Every single one, no exceptions. The sellers lost. The ones who stayed calm won. This is not a coincidence. This is a pattern. And the people who know this pattern buy when fear is at its absolute highest. The second thing, they knew exactly where to look before the crisis even started. And this is the most critical point in this entire video. These people didn't make their decisions when the war started, because when the war starts, it's already too late. The market has already priced it in. Once the headline drops, everyone is doing the same thing. The winners were the people who had prepared beforehand. Think about it this way. During geopolitical crises, there are always a few sectors that tend to win, and they're not a secret. The first one is energy. War threatens oil supply, straits close, supply gets uncertain, oil prices go up. Energy companies win. Look at 2022, the year Russia invaded Ukraine. The S&P 500 dropped roughly 18% that year, a bad year for almost everyone. But the energy sector, ExxonMobil was up roughly 87% that year. Chevron was up roughly 53%. XLE, the energy sector ETF, was up roughly 65%. While everyone else was losing money, the energy sector was breaking records. And this is where it gets interesting. While the market was down 18%, the right sector was up 65%. That's not just protection, that's active growth during a crisis. And you don't need to be a genius to figure this out. When a war threatens oil supply, energy companies are going to benefit. You don't need an economics PhD to see that coming. The second sector is defense. We already talked about Afghanistan. 10,000 into the top 5 defense contractors, 97,000 out. Lockheed Martin alone was up 40% in 2022 when the Ukraine war broke out. Keep that number in mind. But here's something I need to be really direct about. Most people hear all this and immediately think, okay, there's a war coming. Let me just buy defense stocks right now. And that is exactly the wrong way to think about it. Because if you're just now arriving at that idea, the market got there way before you. The news is already priced in. You might already be too late. That's not what the actual winner does. The actual winner is the person who prepared before the crisis. The person whose portfolio was already diversified. The person who is already carrying some energy, some defense, some gold. And when the crisis hits, that person doesn't panic at the screen. They just say, I was expecting something like this, and they keep moving. Preparation beats opportunism, every single time. The third thing, and this is the most important, they never abandoned long-term thinking. Let me give you a number that most people don't think about. World War II, 1939 to 1945, the most destructive conflict in human history. And during that war, the American stock market overall gained value. The Dow Jones closed higher in 1945 than it was in 1939. During the world's deadliest war, the market went up. Stay with me here. Why? Because war doesn't stop the economy, it redirects it. And humanity kept producing, selling, growing. The post-war period, the 15 years after 1945, became one of the strongest growth eras in the history of the American stock market. The people who bought before the war and didn't panic caught the biggest bull market of their lifetime. Exactly them. Same thing happened after the Gulf War, after Afghanistan. Every single time, the same pattern plays out. Crisis hits, market drops, crowd panics, a minority stays calm and buys, crisis passes or gets priced in, market recovers, that minority wins. This cycle hasn't ended, and it's playing out again right now. All right, let me get practical. Because knowing the history is one thing, doing something with it is another. What can you actually do today, right now, whether you're starting from zero or have a small portfolio? 4 things, concrete, actionable, no vague advice. The first thing is build your emergency fund and don't touch it. This isn't specifically about war, it's basic finance, but it becomes even more critical during geopolitical crises. Markets swing wildly, job situations get uncertain. You need at least 3 to 6 months of expenses in cash, because without that cushion, when the market drops, instead of buying at lower prices, you're forced to sell your portfolio at the worst possible moment just to cover your bills. That is the most painful scenario you can be in. The second thing is add some energy exposure to your portfolio. You don't have to pick individual oil companies. Think about something like XLE, an energy ETF with ExxonMobil, Chevron, ConocoPhillips inside it. When geopolitical tension rises, oil supply gets threatened, and these companies generally win. Even just 10% of your portfolio in energy can act as a natural hedge when crisis hits. The third thing is hold some gold. GLD is an option. Physical gold works too. The amount doesn't have to be huge. 5 to 10% of your portfolio is enough. Gold doesn't always win, but during crises, when everyone is panicking, gold has historically held or gained value. Think of it as insurance, and you don't overpay for insurance. The fourth thing, and this is the most important habit, when the headline drops, wait before you sell. The next time you hear a major geopolitical headline and that sell everything feeling hits you, pause. Remember the 47 trading days. The S&P 500 recovered from every major crisis within that window. Every single one. And if decades of data is telling you something, it's telling you that feeling is wrong. But here's the deeper issue. Because the practical steps matter, but they're not actually the real problem. The real problem is this. Most people hear all of this. They've read it somewhere. And they still panic when the next crisis hits. Why? Because our brains feel short-term pain much more intensely than long-term gain. This is called loss aversion in psychology. Research shows that a loss feels about twice as powerful as an equivalent gain. The pain you feel when your portfolio drops $1,000 is twice as intense as the joy you feel when it gains $1,000. And war headlines push this feeling to its absolute peak. Most people don't realize this about themselves. They think they're rational. They think they'd buy the dip. But until you're actually sitting there watching your portfolio drop in real time with missiles on the news, you don't know how you'll actually respond. And this is where most wealth is permanently lost. Not from bad investments, but from emotional decisions made in the worst possible moments. Here's what changes everything though. The people who built wealth during crises didn't stop feeling fear. They were scared too. But they did one thing differently. They used the fear as data. The market is dropping and everyone is scared. That means prices are getting cheaper. Fear became a signal for opportunity, not a reason to run. That mental shift doesn't happen overnight, but once it clicks, you can never go back to looking at headlines the same way. Let me tell you something nobody is saying out loud. Whatever happens, Iran, US, Ukraine, China, Taiwan, whatever comes next, markets price it in. They always have, both the bad scenario and the good scenario. And in the long run, after every war, after every crisis, humanity kept building, kept selling, kept growing. Companies kept making money, economies kept expanding. Look at the entire history of the stock market, and it only ever did one thing, went up over the long term. Understanding that versus actually believing it, those are two very different things. Most people understand it, they don't believe it. And because they don't believe it, when crisis hits, they sell. And in that exact moment of selling, they hand their wealth over to the people who do believe it. Think about that. Every person who sells during a crisis is directly helping the person on the other side of that trade get richer. Which side do you want to be on? Look, this video wasn't made to tell you everything is fine and you don't need to do anything. Geopolitical risks are real. The uncertainty is real. Thinking about your portfolio and preparing matters. But there is a massive difference between thinking and preparing and panicking and selling everything. The people who built wealth were always the ones who prepared, not the lucky ones, the ones who thought ahead, the ones who diversified their portfolios, the ones who kept their emergency fund ready, and the ones who, when crisis arrived, trusted their preparation and stayed calm. History has shown this over and over again, and history is repeating itself right now. 20 years from now, you're going to look back, and you're going to remember what you did during the geopolitical uncertainty of 2025 and 2026. Either you'll say, I panicked and sold, or you'll say, that period ended up being an opportunity for me. If you want to be able to say the second one, start preparing today. Build your emergency fund, add some energy exposure, some gold, keep investing consistently in long-term ETFs, and the next time a crisis headline drops, before you do anything, remember this video. Because while the crowd panics, real investors are buying. That hasn't changed. It never will. If this video made you think differently about something today, drop a like. Because most people are going to watch this, say, that makes sense, and then panic at the very next crisis headline anyway. Don't be that person. A like takes 2 seconds, but actually holding your positions when the market is dropping, that's the hard part. Pull that off and the rest takes care of itself. Subscribe. See you in the next one.